I'm Craig Popp with Accrue Wealth. Welcome back to Charts That Matter. In the previous episode, we highlighted some of my favorite charts from the JP Morgan Guide to the Markets. Today, we're going to continue with that, but changing gears a little bit and focusing in on some of my favorite fixed income slides. The first slide I want to highlight is the impact of a 1% change in interest rates to performance of various bond instruments. As you can see on the right side of this chart, it basically assumes a 1% rise or fall in interest rates. This is important because old bonds and new bonds compete with each other for your investment dollars. And as changes in interest rates occur, bond prices must adjust as well to make either the new or old bonds attractive to investors. So let's start by looking at the left side of this chart. What happens if there's a 1% rise in interest rates? As interest rates go up, bond prices come down. This is important after the painful year investors experienced in 2022. As interest rates rose, bond prices fell rather dramatically as we experienced the worst year ever for the Bloomberg US Aggregate Bond Index. The potential for further rising rates has made some investors scared to purchase fixed income investments. What I think this highlights is that most of the pain has already been felt. The fact is, a further increase in interest rates has less of an impact to your total return. We're going to highlight that a little bit further in a future slide. The other concept that's important is the potential for falling interest rates, as it appears the Fed may cut interest rates this year. As interest rates fall, bond prices go up. From a total return perspective, you can see the impact that a 1% rise in interest rates may have to your portfolio. The next slide highlights the yield to worst across various fixed income sectors. Yield to worst is a good concept of just what sort of interest payment or coupon will we achieve. This chart supports the comment that I've made several times in many of my videos that bonds are back. The two important things I would highlight here is first, the purple bar, which shows the 10-year median yield to worst across the various fixed income sectors. And next would be the blue diamond, which highlights the current yield to worst. As you can see, across all fixed income sectors, yield to worst is materially higher. That's a good thing for us as fixed income investors, because it simply means in today's investment dollars, we are achieving a higher yield with our investment choices. The next slide details the total return of the Bloomberg US Aggregate Bond Index for various calendar years. As I mentioned before, this also ties into the first slide I showed you in our sources of total return. As fixed income investors, we can break our sources of return down into three categories: yield, change in interest rates, and the change in spread relative to treasuries. You can see in the various calendar years, there's quite a bit of volatility among those sources of return, highlighting first 2022, where we saw interest rates rise dramatically. And as you can see on this chart, the negative return experienced from a change in the yield was rather dramatic. On the other side of that, let's look at 2007 and 2008. As we were entering the Great Recession, interest rates fell rather dramatically, and we achieved total return in the form of coupon plus change in spread. So as we think about the future of interest rates, let's look back to that previous chart. If interest rates rise from here, we will see a negative return from the change in treasury yields. However, as you can see, that will be offset by the coupon that we receive. In many cases, the coupon may actually offset the decline in price, thus we're still achieving a positive return. Conversely, if yields do fall, as it's predicted the Fed may cut interest rates this year, we will achieve total return in the form of positive attribution from the change in Treasury yields and the coupon that we receive. This concept is important to me because today my belief is too many investors are way too comfortable being comfortable invested in cash. And the concept of total return from fixed income investing is an important part of that belief. If interest rates do fall, we will achieve that attribution that is positive from the change in treasuries as well as the coupon we get. In cash, since it is really a short-dated instrument, you do not receive the change in treasury yields. Thus, as I think about our forward-looking return, we may be able to see higher potential from taking some risk in fixed income investments versus being comfortable in cash. Thanks for watching. Contact me if you have any questions.